Welcome back. Today we're diving into an analysis report on the massive 129% spike in CETX.
Right.
It analyzes the stock's microfloat mechanics and its potential to squeeze toward that pretty ambitious $11 analyst target while also weighing some really significant financial risks.
And it's a phenomenal setup. I mean, the immediate takeaway here is the incredible job it does identifying the core technical catalyst. Nailing that 1 for 15 reverse split, and then correctly calculating the float down to only around 739,000 shares?
Yeah, it's tiny.
That foundational, data-driven explanation for the big move is just undeniably robust.
It's the engine of the entire thesis, really. The core mechanism is perfectly clear. It's an extreme supply-demand imbalance, all driven by that decimated float count.
Right.
But for a piece that's aiming for maximum impact on an expert, we see a few opportunities to really maximize its authority and the structure of the argument.
I agree. The material is already strong, it's timely, but the goal now is to give it that intellectual gravity it needs.
Especially when we're talking about moves this dramatic.
Exactly. And risk profiles that are this volatile. It needs that extra layer of critical analysis to really land with authority.
So we've identified 3 key areas. Let's start with the first major point for improvement.
Okay.
The analysis report establishes a powerful technical narrative based on that microfloat. But the fundamental justification for the $11 price target remains, well, a little too thinly supported.
That is a critical structural weakness. I mean, the material does an excellent job isolating the technical driver, that tiny float, as the reason for the 129% move.
It explains how it happened.
It explains how the stock moved, exactly. But it doesn't really address why it should keep moving toward that $11 valuation.
Precisely. The bull case that follows, it leans very heavily on just 2 isolated facts.
The analyst target and the PS ratio.
Exactly. The average analyst target of around $11 and that extremely low price-to-sales ratio of 0.07.
And to its credit, the report is very honest about the risks.
Oh, absolutely. It points out the company is still burning cash. Net income is negative $7.2 million, and it's carrying a high debt load.
So as I'm reading the thesis, the argument seems to be that the PS of 0.07 suggests the company is valued at, pennies on the dollar relative to its $76 million in revenue.
Which quantitatively looks compelling.
It does, but that's where an expert reader really pauses.
That's the moment of maximum skepticism we have to address.
Right.
Because if the company is actively losing money, running a negative margin, and carrying all this debt, the mere existence of that $76 million in revenue, it doesn't mean the 0.07 PS ratio is a measure of cheapness.
No, it's often a sign that the market is pricing in the risk.
The risk of default or just sustained losses. So in that context, the low valuation could actually be seen as, accurately priced for that fundamental weakness.
Which then begs the question, why would analysts assign targets 50 or 60% higher if the immediate financials look so negative?
And that's the missing link.
The analysis report tells us what the targets are, but it completely omits why those analysts see a path to growth that somehow overrides the debt and the cash burn.
And that's where the intellectual robustness kind of falls apart.
So to make that $11 target feel less like, speculative hope and more like a real attainable outcome, the material needs to introduce a fundamental hook. Some specific operational positive that bridges the gap between that low valuation and the analyst's confidence.
That's the intellectual weight you need for a squeeze thesis like this.
And it doesn't need to be a full 10K breakdown, not at all.
No.
Just a pointer. A single powerful reason that suggests that $7 million loss is temporary, or that the revenue is sustainable, and maybe even poised for margin expansion.
Okay, so let's get practical. We look at the bull case section.
Right.
The material should just briefly contextualize the source of that $76 million in revenue. Maybe just a sentence or two dedicated to a specific high-margin segment or some new growth area that analysts are probably extrapolating from.
Is there a high-margin Internet of Things division they're modeling?
Or maybe a big new contract win that guarantees future sales. Something concrete.
If you can anchor that valuation gap to a concrete operational positive, the entire bull case just transforms instantly.
The reader gets it.
The reader understands, okay, so the squeeze thesis isn't just about the float, it's about the potential for the analyst's model to actually play out if the specific segment executes.
Exactly. This lets the analysis frame that low PS ratio not just as a number, but as an opportunity that's tied to a specific growth driver.
And suddenly, that $11 target goes from being a hope to a potential outcome that the market just hasn't fully priced in yet.
Highly actionable. and it really adds that necessary context.
Okay, good.
Let's move on to our second major area. This one deals directly with the writing style and the tone,
Yes.
which is especially important given how volatile this whole situation is. The material's aggressive terminology, at times, it risks undermining the analytical authority you need when you're discussing these complex financial mechanics.
It's a matter of stylistic dissonance. I see that. The writer brings this undeniable energy to the price action, which is valuable, in this kind of medium.
It is, it's engaging.
But the descriptors used, they sometimes tip the balance a little too far.
Like what?
Well, the analysis uses these vivid, high-impact descriptors, calling the stock a microfloat monster, and then it concludes with that really dramatic line, it doesn't walk, it teleports.
Which, they're catchy. They definitely capture the excitement of a 129% move.
They do, but they create a sort of whiplash effect when they're immediately followed by really sober risk factors.
Like the high debt-to-equity ratio or that critical support level at 484.
Exactly. For an expert investor reading this, mixing that kind of sensationalism with precise finance can make the whole piece feel a little less authoritative.
As if the excitement is overriding the due diligence.
Right. I wonder, though, if we drop Microfloat Monster, do we risk losing some of that high-octane excitement that you need to engage people?
That's the challenge. We don't want to lose the energy. We just need to shift where that energy comes from.
Okay.
The material should maintain the excitement, but focus the dramatic language on describing the effects of the technical structure.
Not anthropomorphizing the stock itself.
Exactly. Let the raw data carry the weight.
I mean, a plus 129% move, a float under 740,000 shares, a 20% after-hours pullback. Those numbers are dramatic enough on their own.
They prove the thesis without needing the flashy labels.
So building on that, how do we tighten up the language to project that maximum rigor? To show an experienced reader that this is based on deep knowledge?
Well, let's start with that conclusion section. Instead of the subjective observation that, it doesn't walk, it teleports.
Yeah.
The analysis could rephrase this to be metric-driven, but still just as impactful and specific.
Give me an example.
Something like, the extreme volatility, evidenced by the 20% pullback after hours, shows that price discontinuity is inherent when the float is under 740,000 shares.
Price discontinuity. That's good.
It tells the same story of rapid, dislocated movement, but it uses the data points and precise financial terminology. It just signals a higher level of sophistication.
That is significantly stronger. It grounds the subjective observation in objective mechanics. And we could do that earlier, too.
Where?
In the sections explaining why the explosion happened. The thesis should introduce and prioritize more academic terms.
Instead of just relying on the monster moniker.
Right. Introduce terms like a liquidity premium, or really emphasize supply-demand imbalance as the core scientific driver.
Using those precise terms, explaining this as an illiquidity premium being priced in, it frames the whole thing as a quantifiable market phenomenon.
Which justifies its analysis over just a descriptive nickname.
It elevates the discussion instantly, and it reassures the expert reader that the foundation here is academically solid, even if the price action is explosive.
Perfect. That addresses the stylistic issue. Now, for our third and final point, let's look at the structure, the flow, especially how it handles that most high-stakes element, the volatility.
Right. I believe the current structure isolates the critical information about volatility when it could and really should be integrated as the central organizing principle that links the bull and bear cases together.
The analysis does provide the crucial data points on volatility right up front.
It does. It mentions the stock hitting 970 and then that immediate aggressive 20% pullback after hours to around 564.
That 20% drop is the moment of greatest tension and conflict in the whole piece.
It absolutely is. But it's treated sequentially. It's mentioned in the hook, then again in the bear case, then summarized in the key levels.
It diffuses the impact.
It diffuses the tension. The analysis treats volatility as a fact about the stock, not as the primary conflict that actually defines the entire trade.
That makes a lot of sense. For analysis that's designed for a fast-moving environment, that tension is the whole story.
So what's the fix?
We need to refactor the flow to use that extreme volatility as the central conflict. Every single point after that, the bull case, the bear case, the key levels, should be explicitly framed around the struggle.
A struggle between who?
Between the momentum traders trying to push it to $11 and the aggressive profit takers who are responsible for that 20% drop.
That makes the whole thing instantly more dynamic. The story isn't just stock goes up.
No, it's stock goes up against fierce, immediate resistance.
It's a duel, a high-stakes duel between momentum and profit-taking. And the analysis needs to reflect that constant struggle.
Okay, so let's apply that. How does that look in the bull case section? How do we incorporate the significance of that 20% drop?
The current analysis says something like, if the stock can hold support above $5, momentum traders may look to fill the gap toward that $11 analyst target.
It's a bit neutral.
We need to amplify the significance of holding $5 by connecting it back to what just happened.
So define that support level as a victory condition over the initial selling pressure.
Exactly. A concrete example would be, if the stock can hold support above $5, it signals momentum has successfully absorbed the aggressive 20% after-hours pullback, clearing the path toward the $11 target.
That redefines $5 not as just some random line on a chart,
but as the critical battle line, the point where the momentum traders proved they were stronger than the profit takers.
That structural shift is really powerful. It uses past volatility to define future risk and reward. We should mirror that in the key level section too.
On the downside?
Yeah, focusing on that ultimate breakdown level of 484.
Absolutely. In that key level section, make the consequence of breaking 484 explicit by tying it back to that after-hours selling.
So instead of a neutral statement,
rephrase it. Breaking $4.84 signals that the aggressive profit-taking seen yesterday is accelerating, ensuring the downside gap fills quickly, potentially back to the previous base.
By threading that volatility through every structural point, the analysis stops being just a collection of facts about a volatile stock.
And it becomes what?
It becomes a single, unified, high-stakes narrative of risk versus reward. And that just strengthens the whole piece for that fast-moving expert audience.